Hello, finance enthusiasts and savvy investors. It's Iggy here, from the Investing Iguana channel, where we dive deep into the currents of the financial markets to bring you the most impactful analyses and investment insights. Today, we're spotlighting Seatrium, a company that's been making waves for its bold strategic moves and its latest rating. The headline? Seatrium Rated BUY at $0.164. Why? In this video, I'll unravel the mystery behind Seatrium's recent actions, the significant adjustments in its financial outlook, and exactly why CGS-CIMB's Lim Soo Kee is backing Seatrium with a buy rating, despite a backdrop of challenges. If you're keen to understand the dynamics of strategic reviews, asset write-downs, and what these mean for Seatrium's future, you're in the right place. Let's dive in and explore whether Seatrium is indeed a golden opportunity or a cautionary tale in the making. In a significant development on January 30th, Seatrium, a prominent player in the industry, announced a strategic shift in its operations. This shift is characterized by a decision to write down surplus non-core assets and inventories. This move is seen as a bold step towards achieving financial prudence and enhancing operational efficiency. The decision to write down assets is a common practice in businesses when they identify that certain assets are no longer beneficial or necessary for the company's operations. It's a way of acknowledging that these assets might not generate the expected future profits. This is a clear indication of Seatrium's commitment to streamline its operations and focus on its core business. However, every strategic decision comes with its own set of challenges. In the case of Seatrium, this strategic shift is expected to result in a significant increase in its net loss for the fiscal year 2023 forecast, FY23F. This means that the company is anticipating a higher loss in FY23F compared to the financial difficulties it faced in FY22. This might seem alarming at first glance, but it's important to understand that such financial outcomes are often expected when a company is in the process of restructuring its operations. It's a part of the process of trimming down the inefficiencies and paving the way for future profitability. In conclusion, while Seatrium is bracing for some short-term financial turbulence due to its strategic shift, it is also setting the stage for a more efficient and focused operational structure in the long run. This move could potentially lead to better financial performance in the future, once the company has fully adapted to its new operational strategy. The financial analysis of Seatrium anticipates a significant write-down of approximately 250 million Singapore dollars in the second half of the fiscal year 2023 forecast. A write-down is a reduction in the estimated or nominal value of an asset, and in this case, it's a substantial amount. This projection indeed raises concerns about Seatrium's financial health as it indicates a potential decrease in the company's overall value. However, it's important to understand that write-downs are often a part of strategic financial adjustments. They can be seen as a company's way of acknowledging that certain assets may not yield the expected returns, thereby aligning the book value of the assets more closely with the market value. While this might cast a shadow over the company's immediate financial outlook, it also reflects Seatrium's commitment to financial transparency and accuracy. In response to these financial adjustments and a cautious outlook on the recovery trajectory, the company has recalibrated its expectations for gross margins. Gross margin is a key profitability metric that represents the percentage of total sales revenue that the company retains after incurring the direct costs associated with producing the goods and services it sells. The new expectations for Seatrium's gross margins have been adjusted to 5.5% for the fiscal year 2024 forecast and 10% for the fiscal year 2025 forecast. This is a downward adjustment from the previously anticipated gross margins of 8% and 13% for the respective years. This revision reflects a more conservative and perhaps more realistic expectation of the company's profitability in light of the current circumstances. In the midst of these financial adjustments, there emerges a glimmer of optimism. The target price for Seatrium, which is essentially the price at which a financial analyst believes the stock is worth buying, has been revised to 0.164 Singapore dollars. This new target price can be seen as a silver lining, as it provides a renewed perspective on the company's value. This revised valuation is based on a 1.4 times price to book value, P/BV, for the calendar year 2024 forecast. The price to book value is a financial ratio used to compare a company's current market price to its book value, which is the value of an asset according to its balance sheet account balance. In this case, the P/BV has been slightly adjusted from the previous 1.5 times, indicating a nuanced understanding of Seatrium's evolving financial landscape. This adjustment reflects a more conservative valuation of the company, taking into account the recent strategic changes and the anticipated financial impacts. It shows that while the company is going through significant changes, the financial analysts still see value in the company's future. In essence, despite the short-term financial turbulence, the revised target price suggests that the market still holds a positive outlook for Seatrium's long-term prospects. It underscores the belief that Seatrium's strategic adjustments today are steps towards a more profitable and sustainable future. Even with the downward adjustment of profit expectations and the recalibration of financial forecasts, the report continues to maintain an ADD rating for Seatrium. An ADD rating is a financial term used by analysts when they believe that a particular stock has a good chance of performing well and is a good addition to an investment portfolio. This shows that despite the current challenges, the analysts still see potential in Seatrium. This optimism is based on two key factors. The first is Seatrium's streamlined asset base. Streamlining assets means that the company has been successful in focusing its resources on its core operations, getting rid of any excess or non-core assets. This not only helps in reducing unnecessary costs, but also allows the company to focus its energy and resources on areas that are most likely to generate profits. The second factor is Seatrium's promising order pipeline. An order pipeline refers to the orders that a company has received but has not yet completed. A promising order pipeline means that there is a steady stream of work lined up for the company, which could potentially translate into steady revenue in the future. These two factors together suggest a potential rebound and opportunities for growth for Seatrium. A rebound would mean that the company is expected to recover from its current challenges and start performing well again. Opportunities for growth refer to the potential for the company to not just recover, but also expand its operations and increase its profits in the future. And that wraps up our deep dive into Seatrium and its intriguing buy rating at $0.164. We've navigated through the strategic shifts, financial recalibrations, and the optimistic outlook despite the hurdles ahead. Seatrium's journey is a testament to the complexities of financial management and strategic planning in today's ever-evolving market landscape. Whether you're a seasoned investor or just getting started, Seatrium's story offers valuable lessons in resilience, strategic foresight, and the art of navigating uncertain waters. If you found this analysis enlightening and wish to stay ahead in the game with more insights and updates from the financial world, hit that like button, share this video with your investment circle, and don't forget to subscribe to Investing Iguana. Your engagement is our greatest motivation to continue uncovering the stories that matter to you, the smart investor. Until next time, keep your investments wise and your strategy wiser. This is Iggy, signing off. Happy investing, and see you in the next video.